We need to talk about 6 costly ETF mistakes I see European investors make far too often. Avoiding these is likely to save you many thousands of euros throughout your investment career, and for some of you could be the difference between being able to retire early one day or getting discouraged and abandoning investing altogether. In fact, if we consider the compounding effect of these mistakes over decades, the impact on your retirement portfolio could easily reach 6 figures, money that should be working for you instead. Just so you know where I'm coming from, my wife and I have been investing primarily in ETFs for over 8 years now, with the goal of being able to stop working, if we so wish, in a few years, together with our 2.5-year-old daughter here in Austria. Throughout this journey, I've made my fair share of mistakes myself and learned a lot from the experience. Anyway, let's not waste any more time and get to costly mistake number 1, investing too frequently. Don't get me wrong, cost averaging, meaning investing into the market via low-cost, well-diversified ETFs on a regular basis, is a great long-term strategy, but some people take cost averaging way too far. In my opinion, investing on a weekly basis makes no sense, for example, unless you get paid weekly as well, which I doubt is the case. Once a month is plenty, ideally via an automated recurring investment so that you don't have to think about it. Otherwise, you may end up sacrificing a good portion of your money to trading fees, like €50 extra each year, even if they're as low as 1.25 euros on interactive brokers using tiered pricing. That's money that could have been invested and working for you instead. Not to forget how much your time is worth in case you're placing these orders manually. Now, if you're using a broker like Trade Republic with commission-free recurring investments even on a weekly basis, you can of course choose this option. But you shouldn't expect your results to be better compared to monthly contributions. In fact, chances are the opposite is likely to be true. Since an ETF covering the global stock market like the FTSE World or MSCI All Country World has a positive expected long-term return of 7% per year on average, the sooner the money is invested, the better the returns historically. Let's look at 2 graphs from the German newspaper Welt that show this more clearly based on historical data. From 1972 to 2024, the MSCI All Country World has on average started day 1 of each month at 0% and returned 0.8% by day 31. And for the MSCI World, a recurring €100 investment at the start compared to the middle of each month has also slightly outperformed since 2015. So investing your money as soon as you get your paycheck tends to yield the best results compared to waiting. It doesn't matter if that's at the start, the middle or the end of the month. By the way, you can find my favorite low-cost brokers in Europe for ETFs down in the description below, which is a great way to support me if you'd like to. Mistake number 2, switching ETFs without considering taxes. Just like in every market, there's a ton of competition in the ETF space as well. By cutting fees on an ongoing basis or by launching new funds with lower fees, fund providers are constantly working to attract more investors and in the best case from their perspective get some of us to move from a competing fund to theirs. And since ETF investing in itself is quite boring, it can be tempting to switch to a new ETF with lower fees. After all, while it's impossible for us to know what the market returns in a given year will be, the total expense ratio each fund charges on a yearly basis is the one thing we can control. So it does make sense to pick an ETF with lower ongoing charges for our strategy long term. But here's the mistake many investors make. If you already hold ETF shares that are up substantially, as is the case with my wife and I, it doesn't make sense to sell those shares and to have to fully tax those profits already now, instead of later on in retirement when you actually need the money. For example, in Austria, where I live, we have a capital gains tax of 27.5%, most of which I'd like to defer as far into the future as possible. If you'd like to know more about taxes on ETFs in 22 European countries, make sure you check out this video next if you haven't seen it yet. The taxes you would need to pay by moving your money from one ETF that's in profit to a new one are likely to far outweigh any small difference in yearly fees. Unless of course you're lucky enough to be based in a country with 0% capital gains taxes, but for most of you watching that's sadly not the case. As a result, after feeling a bit frustrated that Vanguard hadn't lowered its fees for over 5 years while its competition did, my wife and I simply started buying another, less expensive ETF with our monthly savings in July 2024 instead, in our case the accumulating Invesco FTSE World. We did however hold on to our existing X-Trackers MSCI World and Vanguard FTSE World shares for the tax reasons I just mentioned, as they're still in line with our global investing strategy. To sum it up, whenever you consider making changes to your investment portfolio, don't forget to keep taxes in mind. Mistake number 3 is related to this, constantly changing your investment strategy. Whenever the market shifts, it can be incredibly tempting to change strategy. When tech stocks are booming, people start eyeing tech-heavy ETFs like the Nasdaq 100 or MSCI World Information Technology. After defense stocks have been rallying, everybody wants defense sector ETFs. When US stocks underperform, everybody starts flocking to Europe ETFs. And the opposite tends to happen, of course, after a period of outperformance in the US. Arguments of why an S&P 500 ETF is all you need start to appear everywhere. Last year that sentiment was all over Reddit, for example. But this year we're seeing the opposite. Europeans are actively trying to avoid US stocks for political reasons. This is called trend chasing, which tends not to work out too well. Not only will you lose more to taxes long term, as we've discussed in a previous chapter by moving from one ETF to the next, but most people actually end up buying high and selling low as soon as investor sentiment shifts again, and you're suddenly not convinced of what once seemed to be a great investment idea. This ties in well with mistake number 4, not understanding what you're investing in. When buying an ETF, you should understand exactly what you're investing in and why this strategy could make sense long term, ideally by looking at several decades of historical data for that index. You don't want to end up investing into something only because someone else on the internet or a friend is doing so, without internalizing the reasons for that decision yourself. Otherwise, you'll probably sell even a broad, well-diversified market ETF like a FTSE World, All Country World, or MSCI World at the worst possible time, for example during a market correction or crash, and end up with a loss, instead of getting anywhere close to its historical average returns over decades. By the way, that number was simply the historical average which the market rarely hits in a single year. As you can see here, you're a lot more likely to see the market go up 19% or 20% one year, down 13% another year, and so on. And while an All Country World index had a positive return in 63% of the 448 months since 1988, things were even better on a yearly basis, achieving a positive return in 76% of the last 37 years. While there are obviously no guarantees, I like to calculate with a long-term average of 7% per year for my investments in global low-cost ETFs based on historical data with plenty of ups and downs in between. By sticking to our simple ETF investing strategy through both good as well as difficult years, my wife and I currently have an average yearly return of 10.3% since 2017. My personal conviction is that investing in a globally diversified market cap weighted ETF like the FTSE World or MSCI All Country World makes a lot of sense, as it enables me to easily be invested into thousands of the most productive companies from all across the world and get my fair share of their growth. Since the stock market has historically always gone up over long time periods, this passive investment style makes the most sense to me personally, and is why I'll continue sticking to my strategy through difficult periods as well, when many other investors may be freaking out. So make sure you understand what you're investing in, why you chose a given strategy, and how it has performed in the past, if possible over the longest possible time frame, like several decades. If you do that, you're a lot more likely to stick to it in the long run, meaning at least 5 years, ideally 10 years or more, increasing your chances of good returns. Mistake number 5, picking the wrong ETF version. Most fund providers usually enable you to choose between a distributing or accumulating ETF covering an index. Distributing simply means that the ETF pays the dividends it receives from the stocks it holds out to you in cash at regular intervals, usually quarterly or once a year, depending on the ETF, while an accumulating ETF reinvests those dividends on an ongoing basis, acquiring more shares of the stocks it holds. Let's look at the impact on your ETF shares value over time. The accumulating Vanguard FTSE World has gone up close to 79% since July 2019, while the distributing version shares on the right increased only 62% in value over that same period because it paid out around 1.8 to 2% in dividends each year to its investors instead of reinvesting them. If we were to assume zero taxes on dividends and zero cost for reinvesting them into more ETF shares on your end, which you would have to do as soon as you receive them, then the performance of the two versions would likely be almost identical. Sadly, that's not realistic. In most European countries, investing in accumulating ETFs is a lot more tax efficient long term, as you usually have to pay taxes on dividends that are paid out to you in any given year. Meanwhile, accumulating ETFs enable you to defer those taxes into the future and keep your money working for you longer until you actually need it, for example in retirement. Keep in mind, I'm generalizing here. There are of course tons of differences depending on the country you're based in. Austria is quite complicated, for example, so make sure you understand how taxes work where you live. I'll link a video up here which may help you get started with that. But even if we put taxes aside, an accumulating ETF is still easier in most cases, as you don't have to waste any time or money on trading fees, reinvesting dividends that are paid out to you. That being said, there is nothing wrong with you holding a distributing ETF instead if that's your preference. If receiving regular dividend payments to your brokerage account and seeing that cash flow increase over time is the motivation you need to stick to your strategy, then go for it. It likely won't be the most tax efficient way to invest in ETFs, but that's okay. And lastly, number 6. Waiting too long to finally start investing. People spend months, sometimes even years, researching the perfect ETF investing strategy or waiting for the right time to start investing. The thing is, there is no perfect time, the future remains uncertain, and there will always be something to worry about next. And the one regret I hear the most from my viewers in the comments is that they wish they had started investing sooner. Doing your research is of course important, and I've just spent the last 10 minutes explaining why knowing what you're investing in matters. But make sure you don't fall into analysis paralysis and just get started. Even if it's a smaller amount, like 50 euros per month, you're able to put into an ETF, you'll be building a habit of saving and investing on an ongoing basis in order to get closer to your financial goals, and you'll get used to the ups and downs that are a normal part of investing in the stock market. So there you have it. 6 costly ETF mistakes I see European investors making on a regular basis. Avoiding these mistakes could save you many thousands of euros, perhaps reaching 6 figures throughout your investment career. My wife and I have certainly made some of these ourselves over the years, particularly in our early days of investing. But we try to learn from them on an ongoing basis. The good news is that ETF investing doesn't have to be complicated. Pick a simple strategy that makes the most sense to you over the long run, for example a globally diversified ETF. Try to minimize costs and taxes on an ongoing basis and stick with it through market ups and downs, of which there will be plenty, keeping your long-term financial goals in mind. If you enjoyed the video, don't forget to gently tap the like button and to subscribe if you haven't yet. You can find what I consider the best low-cost brokers in Europe for ETFs linked down below, which is a great way to support me if you'd like to. Speaking of that, you should watch this recent video next to find out how to use interactive brokers effectively, ensuring you pay the lowest possible trading fees. As usual, none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.